Well, hello everyone, and welcome to the 2024 Economic Update and Investment Outlook, hosted and presented by Dechtman Wealth Management. We're excited that you took time to join us today. The program is going to be approximately 40 minutes, and we will follow that up with Q&A at the end of our presentation. At the very bottom of your screen, you'll see a Q&A icon. And if you do have questions, we would strongly encourage you to type those in, and we'll do our very best to get to every question noted at the end of our presentation. Important disclosure information, as with every presentation. Thank you, Sam. Okay, so here's today's agenda. We're going to cover a lot of information in a very short period of time. I would encourage you to jot down some notes, grab a pen and paper. Just as an aside, as we always do, we always record these presentations, and we follow it up with an email of the slides and presentation about a week or so after. So we're going to begin the presentation talking about an economic update relating to the Federal Reserve, interest rates, and government debt. Something that's on everybody's mind is a presidential election and what's going to happen with regard to the markets. There are a number of geopolitical concerns that we will address. And I think one of the more informative pieces of the discussion is the stock market outlook. You're definitely going to want to stay tuned for that. And lastly, retirement and tax changes. So we're going to jump right in. Sam is going to lead the discussion, and I will follow up at the end to kind of tie things together. Sam?
Yes, thank you, Jordan, for the introduction. And the first topic we're going to be going over is the economic update. And so throughout today's presentation, you're going to hear us present both sides in a very balanced way. We do think that there is a lot of very positive things going on. And that's really the part that we're going to hopefully put an extra emphasis on, because that's not what we see a lot in the financial media, whether it be TV or publications. But ultimately, a lot of things are going very positive right now. But make no mistake about it, there are also some challenges and gray clouds and concerns, if you will. And so we're going to also make that very apparent as well in terms of what we're looking at, both good and bad. So let's jump right in. The first chart that we wanted to show you is tracking inflation. And the solid blue line that's going across your screen, that is looking at the year-over-year change in inflation. And the dotted orange line, that is looking at the 3-year average. And so one of the main reasons why inflation had spiked, particularly in 2022, is due to what's called the M2 money supply. And so the M2 measure of the money supply soared 41% in 2020 and 2021, the fastest since World War II. This measure of the money supply then declined 3.2% in 2022 and 2023, the largest 2-day drop since the Great Depression. So these swings in the M2 have long lags, and between when you see M2 and inflation really start to mirror each other. And so when we're looking at the graph, as we see the spike and then the sharp decrease, we think a large portion of that, again, is related to the money supply. And so it's this end part of the graph that we can see here, where instead of it continuing its downward descent, we see it sort of move back up and then back down, and we're in sort of a holding period, if you will. And that is what the Federal Reserve is going to be keenly focused on. The Federal Reserve's goal is to try and keep inflation about 2%. And so as we can see, the latest year over year is 3.4. So that is significantly above where they would like it to be, which is why the Federal Reserve has come out and they said, yes, we're still planning on lowering interest rates this year, but it may not happen quite yet. They do need inflation to consistently be moving a lot closer to that 2% number. And so in terms of the way people are feeling at the moment, I equate that more to the orange line, where yes, year over year we're at 3.4%, but in terms of how you felt over the last 3 years, being over 5.5%, particularly when you go to the grocery store, I think that has caused a lot of discomfort in terms of people's lives at the moment. But we do think that things are trending in a more positive direction when you look at them in shorter, quicker, we think responding to real time, data. So what we're looking at is how the inflation rate has changed on a 3-month basis. So instead of year over year, it's looking at it every 3 months. And so what we can see on the far right-hand side of the screen here is that the inflation rate that we're looking here for core services is actually 2.4%. So that is still above 2%, but it's certainly getting a lot closer. And we do think that, as I'd mentioned in the previous slide, with the money supply not expanding so rapidly as it was and it being more measured, we think that's also going to help. And other different technological factors, AI in particular, we think is also going to be very disinflationary. And we're going to spend a moment a little bit later in the presentation talking about AI and its impact. But we think the positive benefits of it is it'll hopefully keep inflation in check by lowering costs in a lot of different areas. So switching gears now from the inflation side to more of the growth side, if you will, we wanted to take a look at how the individual household is doing. On the left-hand side, we'll see real incomes. And on the right-hand side, we'll be spending. And so if we glance back over here to the left side of the screen, we can see that over the past couple years, primarily since COVID, we've continued to see incomes on the rise, which is a very positive thing, particularly when it comes to the economy. So not only are real incomes on the rise, but we've also seen that there's been very solid job growth. Not only have all the jobs that were lost during COVID been recouped, but folks are keeping those jobs and more folks overall are joining our workforce. And on the right-hand side, we can sort of see what they've been doing with that extra income. And ultimately, it's spending. And that is a huge catalyst for future growth in the US economy. US GDP is about consumer spending is about 70% of US GDP. So as long as the consumer is in good shape, they're making money, they have their job, and they're spending, that is a huge cog in the machine that is hopefully going to keep things trending in the right direction. Now, when we're assessing spending, we want to make sure that folks are not getting over their skis and that they are keeping their own personal balance sheets in shape. And this chart sort of illustrates that point. And so what we're looking at here is the debt payments as a percentage of your disposable personal income. So how much of your income are you required to pay through different debt providers on mortgage, car, credit card, student loans, any other type of loan that you're required to make payments? And what we can see here on the far right-hand side is that we're at about 9.9%, which other than the very brief drop that we saw during COVID due to the forbearance on a lot of different debt, we're at nearly the lowest point that we've been in the past 40 plus years. And so we can see here that in 2008, or I guess the end of 2007 rather, that the number was significantly higher. It was also significantly higher in the dot-com bubble. So 2000, 2001, 2002. And so not only are folks making more, they're spending more, but they're not getting, they're not spending irresponsibly. They're making sure that they're keeping their own personal financial affairs in order, which also gives us a good backdrop that if we are to see further turbulence, that folks really are planning properly for any volatility to come. So one of the items that we're keeping very close eye on is what's happening in the banking sector. So I want to first flash back to what we were discussing with all of you last spring. And that was on the heels of the collapse of Silicon Valley Bank, as well as First Republic, and a few others that had actually collapsed. And the reason for that was partly mismanagement by the bank's executive teams, but also a sudden increase in interest rates. And as interest rates went up and you saw customers withdrawing their funds from the bank, it caused a lot of issues. And so the Federal Reserve, what they did to create more sustainability in the system and wanted to provide or project strength, if you will, is they created what's called the Bank Term Funding Program. And the Bank Term Funding Program was created so banks could use the Federal Reserve for loans to cover all deposits to make sure that they were still in good order. And the Federal Reserve told banks, okay, you have 1 year to get it together. And so that time frame actually ends March 11th. So it'll be interesting to see what the Federal Reserve decides to do in the next couple of weeks. If they decide to extend this, what should have been a temporary funding program, or if they pull the training wheels off and let banks sort of fend for themselves, if you will. And so we'll be waiting to see how that's going to play out, and if banks have really done a better job reorganizing their balance sheets. And now, when I'm talking about banks that have had the issues, we're talking mostly small and regional banks. The largest banks here in the United States are very well capitalized, particularly the top four. But what we wanted to show you here on this chart, fast forwarding to today, beyond just what's happening with the Bank Term Funding Program, is related to commercial real estate. And so specifically, we're talking about office buildings within the commercial real estate sector. So on the left-hand side, we can see the top 25 banks. In this chart shows the percentage of their total loans and leases outstanding. So we can see that the entire bucket of commercial real estate for the top 25 banks is 13%. And so an office part of that is only a fraction. And so regarding your personal portfolios and how we invest, when we're looking at the financial sector, it's primarily going to be in the largest banks. It's not going to be in the regional or smaller banks. And so if we do see some issues ahead in the office commercial real estate sector, we think that you'll be largely insulated, from that perspective. Now, if we look here on the right-hand side, this is where we see a potential, issue perhaps. And that's 44% of the outstanding loans for small and regional banks are in the commercial real estate. And a big portion of that is for office buildings. Now, why are we highlighting office buildings? What's happening there? With the change to more remote work and folks leaving a lot of major city centers, you are starting to see vacancies go up, particularly in these large office towers. And so what happens on these commercial loans is the owner of the building who has the loan, they're only required to pay interest. And then at the end of the loan, it's a big balloon payment. And so very frequently, you are seeing these banks that aren't ready to pay that huge balloon payment and don't necessarily want to turn the keys back over to the bank. So what they're doing is they're extending these leases and pushing them forward. But sometimes the bank doesn't necessarily want to kick the can down the road for another couple of years. And so the risk, if you will, is that we see a big fire sale, particularly in these big office buildings, and what that might mean in other areas of the financial sector. So I'll move on to the next topic here, but just wanted to make the point that there are certainly some things, particularly with small and regional banks, that we're keeping our eye out on because we think it could present some additional volatility, not only this spring, but possibly this summer. So now let's shift gears and talk a little bit about the Federal Reserve, interest rates, as well as government debt. So what we're looking at here on the screen is the federal funds rate going back to the early 90s up until where we're at now. And you can see this gray line, which tells you where we've been. And so right now, the federal funds rate is between 5.25% and 5.5%. It's showing 5.38 because that is the middle of 5.25% and 5.5%. But what we see to the right of it is very important and very telling. The blue dotted lines show us what the Federal Reserve, Federal Open Market Committee, is what FOMC stands for, where they believe the federal funds rate will be at the year end. The green tells us where the market predicts, and the purple is where the Federal Open Market Committee, the Federal Reserve, projects interest rates to be for the federal funds rate long term. So there's a couple things that I want to point out to you. Well, one, the Federal Reserve is estimating that by the end of 2024, interest rates are going to be lower than where they're at now, and probably about 1% lower than where we're at now. And so when the market started 2024, it was very excited with the idea that the Federal Reserve was going to cut them and felt like it was going to happen much sooner. But as we also pointed out in the inflation sides, we have seen a recent uptick in terms of what it looks like on a year over year metric. And so the Federal Reserve is being very cautious before they begin to decrease it. And so we can see that the green line, which is the market expectations, is lower than the Federal Reserve expectations on all different fronts. Not only what they expect at the end of 2024, but we can also see at the end of 2025. And it's also worth noting that by the end of 2025, the Federal Reserve expects interest rates to be about 2 percentage points lower, give or take. And so over the next couple of years, the Federal Reserve is expecting interest rates to have a pretty steep drop from where they're at now. So why are they being more cautious about decreasing interest rates now? And why would they even do that in the first place? Well, they want to, by increasing interest rates, which is what they've done over the past couple of years, they are essentially pushing down on the brake. They are trying to slow the economy down in the hopes that it's going to bring inflation back down. Inflation has certainly come down from its massive peak that we saw a couple years ago, but we're not quite at that 2%. So they're worried about easing up off that brake and creating too much growth and sparking rise in inflation again. That was a major fault of what the Federal Reserve did in the 70s and the 80s. During the 70s, there was massive inflation. The Federal Reserve responded in kind by increasing interest rates pretty high. We saw inflation drop precipitously, and so the Federal Reserve said, mission accomplished, we're now going to lower interest rates. But what happened is inflation spiked again. And so the Federal Reserve had to increase interest rates again. And as they increased interest rates, they had to do it for higher and for a longer period of time. And the second time around was so much more painful because we already had the fatigue of going through it the first time. And I think that the wear of going through that period again was very difficult. So the Federal Reserve is trying to avoid that error again, where they decide or they declare mission accomplished and say that they've killed inflation, but ultimately there's still some signs that there's a little bit more work to be done. But the moral of the story here is that at some point, the Federal Reserve is expecting to lower interest rates this year, and we'll have to see what happens and what magnitude that ultimately does. Switching gears now to look at more of the government side of things, we wanted to talk about what outlays there are from the federal government. And the chart that we're looking at specifically is the net interest expense. The bars from 2014 through the end of 2023 are actual. The gold bars that we're seeing on the right-hand side, that is what are projected figures for the net interest expense from the Congressional Budget Office. And so it is expected that America is going to spend $870 billion or 3.1% of our gross domestic product on interest payments this year. That is nearly double the annual average of 1.6% of GDP since 2000. Only Social Security and Medicare are forecasted to be bigger burdens in the coming year. And nearly a third of outstanding government debt is set to mature within the next year, most of which will be refinanced at significantly higher costs. And so the reason why we continue to see it go up like this is for a couple different reasons. One, and this is the last one I just mentioned, as the as the debt is rolling off, the government is going to need to issue more bonds, and it's going to be at significantly higher rates. The reason why the government or the Federal Reserve needs to keep issuing more, or the Treasury needs to keep issuing more debt, is because we run annual deficits. When you spend more than you make, you have to borrow. And so now we're having to borrow at significantly higher interest rates. And so as this continues to happen, we're going to see the interest expense continue to go up and up. And to show you what this looks like versus some of the other programs, we can see here on the dotted line, what is expected to happen in the future, that the net interest is going to surpass defense. Let that sink in for a moment. And soon we're going to pass $1 trillion just in interest payments alone from net interest. And you can also see that Social Security and Medicare also are continuing to go up in a non-linear fashion. They're really starting to go up significantly. And so just a quick comment related to Social Security. The Social Security program will pay as is until the end of 2033. At that time, the Social Security trustees came out with their report and they said in 2034, everyone who is currently receiving a benefit and all future benefits will receive a 20% haircut, meaning you will get 80% of what you are currently receiving. Now, we still have a little bit of time before we reach that particular moment, but the point we're trying to make here is that changes are going to have to be made. Now, who is going to be making those changes? What are those going to look like? Well, there's roughly 65 to 70 million Americans that are receiving Social Security benefits, and the vast majority of those folks vote. They are not voting for anyone who is going to reduce their benefit, in my opinion. So it really be younger generations that are ultimately going to have to backfill the system. And Social Security is very commonly polled as one of the highest ranking government programs out there. So there's a lot of support to keep it going. And so, of course, as changes happen, we're going to keep you very informed as to which direction that might go. At the moment, there are a couple bills that are being thrown out there. And again, we'll keep you abreast about what that looks like. But I do want to end on a slightly positive note regarding this. In order to get the system back on track, of course, it's going to involve some adjustments, but they don't have to be dire and they don't have to be extreme. The first age that you can collect Social Security right now is 62. They could move that back to 64. Most folks' full retirement age now is 67. They could continue to move that back to be more in line with life expectancies. For every year you wait after your full retirement age, right now you get a guaranteed 8% increase in benefit. They could reduce that to 6. They could also increase the amount of income that's taxable to Social Security. At the moment, right now, it's about 160,000. Or they could do some combination of all of the different items that I mentioned. And so the system is not necessarily as dire as you're led to believe, but again, make no mistake about it, changes absolutely need to be made. Now we're switching gears and talking about the presidential election, and the 2 slides that we're going to be going over are purely about market history. We are not sharing who we think is going to win. We're not sharing who we want to win. We're not talking about policies that have been proposed by either party or any of the candidates out there. We're purely just giving you the numbers on what presidential election years look like and what we might be able to expect. And so the first slide that we'll take a look at regarding this is how do stocks perform during election years? And I would say that very often, Jordan, Adam, and myself are told, hey, it's a presidential election year. That probably means the market's down. Well, when we actually went back and looked at the research, we find here, which is the second bar, that in presidential election years, the average annual return is actually higher than what we see when we take all the years in aggregate. And so even though I think there's a lot of negativity on both sides, blaming the other for various issues that are happening, I think that can cloud our judgment sometimes in terms of, how is the stock market actually performing? How are companies really doing? And so I wanted to just bring this to light that even though during a presidential election year, things might seem like they're more turbulent, ultimately, from a historical perspective, we see that they're actually better than, taking all years together. So diving a little bit deeper into how has the market performed during that presidential election year, we can actually see that the first half is generally muted. The first quarter and second quarter are generally pretty pedestrian, but then the second half of the year with the third quarter and fourth quarter happen to actually be significantly better. I think that this is an interesting trend and one that we're aware of. Not quite sure how this is going to impact our investment process at the moment, more just sharing some different statistics, with you regarding this. Now let's spend a moment talking about other concerns that are happening right now, and that is related to different wars going on as well as other geopolitical issues. Wars are horrible on a humanitarian front. And of course, we don't want any to be taking place whatsoever. But we're often asked the question, how would engaging in a war impact the stock market? How is it going to impact my investments? What's going to happen to the economy? And, how are we planning and thinking about it? And so we wanted to present this chart to show you how has it actually done. So we highlighted a couple of major wars that the US has been in and provided the information here. So the blue bars show you what the average annualized return has been over the course of that war. And the gold bar tells you the annualized standard deviation. And that just essentially means volatility, both good and bad. And what we can see when we look at World War II, Korean War, Vietnam War, Gulf War, Iraq War, is that over each of these periods, the market has actually been positive. And so, going back to my previous comment that wars are terrible on the humanitarian side, but when we're looking at them from a stock market perspective, they, I don't want to say they're good, but they're certainly not, bad when especially compared to the far right-hand side here that we can see the average annual return over the course of the market, which we're referencing the S&P 500, is about 10%. And so if the United States, continues the current, support for the various wars that are going on right now, unless this truly becomes a wider scale conflict, we'll maybe need to reassess. But at the moment, we're not invested at all in Ukraine, Russia, minimal investments, I'm sure in a small amount in Israel, a small amount in Taiwan, perhaps, but we're talking very negligible percentages in terms of how the portfolios are invested. So now let's switch gears and talk a little bit about the stock market outlook. We've spent a lot of time looking at the past, but now we're going to try and tell you what we think about the future and what might be to come. So when we're looking ahead, we do want to look slightly back, and so this chart, I think, explains a major point of our thesis for why we think 2024 could be a good year and why we are cautiously optimistic. So the thick blue bar that goes across the screen is the S&P 500 value. And the light blue, if you will, shows the earnings. And so the main takeaway from this is that over time, the value of the S&P 500 follows earnings. So as earnings continue to go up, and earnings, another word for that is profit. So as companies become more profitable, it only makes sense that the value of the companies would also go up. And right now, many analysts are expecting that 2024 will present record profits, particularly for the companies in the S&P 500. And so we think that that provides justification for why the S&P 500 is at near all-time record highs. Now, what is one of the major reasons why analysts are very optimistic about earnings in 2024? Well, that would be AI, or artificial intelligence, or AGI, artificial general intelligence. In 2023, I'd say the public really got a crash course in how this works. You probably have heard of ChatGPT or any of the other companies that have issued free AI to everyone out there. But as we get deeper in 2024 and beyond, companies are really going to figure out how they can integrate this into their businesses to not only make their current workers more productive, but the ability to reduce costs as well as provide value. And so with the introduction of AI, and we think it's going to get better and better, that is something that is a very positive trend that we're going to be keeping an eye out on. So not only do we think that profits are going to be, or the analysts expect them to be in 2024 at a record, we also expect dividends to follow a similar path. And so what we can see here is in 2020 or 2002, all the way up until 2023, just how much dividends have increased over that period of time. And the expectation is that in 2024, we'll also reach another record with dividends. And so dividends are great, and we like dividend paying companies as well as companies that grow their dividends. When a company pays a dividend, it signals strength, that they have enough cash from their operations to continue paying. And when they grow that dividend, it means that they're extremely optimistic about their future prospects that they are able to continue sending money out to shareholders. And so the fact that we're seeing this trend with dividends is also very important. So with the prospect that the Federal Reserve might decrease interest rates at some point, we wanted to take a look and see how does the stock market usually react before and after that happens. Given that we are in a non-recessionary environment at this moment, what's happening here on the left-hand side is much more important. And so this after bucket is, one that we think will be very close to. So what this tells us is the 12-month stock return after the first rate cut. And we can see that generally it's pretty positive. About 12.6% is what happens in the first 12 months on average after the Federal Reserve cuts interest rates. And so there's three main pillars on why we are cautiously optimistic, to put it in a concise way. One is the consumer is in great position. We discussed their incomes are going up, they're keeping their balance sheets in order, and they're continuing to spend. The second is related to the Federal Reserve and the fact that they might decrease interest rates at some point in time, which we can see here generally has been a very historical, from a historical thing, a very good thing. And the last, and we just went over it in the slide previous, is the earnings. As long as the companies in the S&P 500 in particular, but the market at large, continue to increase their earnings, those three are very positive signs, and ones that we think at the moment are outweighing a lot of the negatives that are happening. So for those turning 62 in 2024, you were born in 1962, the year the Beatles auditioned for Decca Records and were rejected. John Glenn became the first American to orbit the Earth. Marilyn Monroe died. The New York Yankees won the World Series for the 20th time. And in the Cuban Missile Crisis, the world came closer to thermonuclear oblivion than at any time before or since. So we want to ask three questions. Where did the S&P 500 close out 2023 relative to where it ended 1962? How much did the index pay in cash dividends last year versus 1962? And how did price performance and dividends compare to inflation? And as we can see here, they have done extremely well. If you were born in 1962, the S&P 500 is up 76 times. 76 times. Dividends are up 33 times. And during that same period of time, inflation was up only 10 times, which is significant, but not when compared to the dividend growth, as well as what the price appreciation was on the S&P 500. And so as we're looking forward and trying to adjust and monitor and navigate inflation potentially lasting, for longer than we would like to in the future, the best performer over time to combat inflation has been stocks. And so if you're at a point where you're in retirement and you're receiving income from the portfolio, we can see that the dividend growth has also outpaced inflation. And so it's very important that no matter where you're at in your journey, to understand from the long-term perspective and a wider lens that the stock market has really provided exponential growth. And, need I remind you that over this exact same period, this includes 2008. This includes the dot-com bubble. This includes the oil embargo. This includes the high inflation from the 70s. This includes the pandemic and COVID. Over the past 62 years, think about everything that has happened and the many, many times that the market has dipped, but yet still it is up 76 times, which is why when we're in the thick of it and we're hearing all the day-to-day noise, it's important to zoom out again and really focus on the bigger picture, on how the United States attracts the smartest people who build the best companies in the entire world. And so even despite all of the issues that are constantly present, people find a way to persevere and continue to push ahead. But if the stock market is not something that still interests you at the moment, this slide is advocating for the money that you have in the bank to at least do something with it. We can see that the average savings account and the checking account earn practically nothing. They're a fraction of 1%. So if you still want to remain conservative, a better alternative that we're suggesting is what is called a treasury bill, or a United States treasury bill. These are bonds that are issued by the Treasury that mature within the next 12 months. And on this particular slide, we're highlighting the 3-month Treasury bill. They are backed by the full faith and credit of the United States government, meaning the federal government is going to ensure that you have a positive rate of return if you hold it for its entire maturity. Another benefit of these is that they're also tax advantageous, and that the interest that you earn on a treasury bill is exempt from both state and local taxes. And they're also liquid, meaning you can get the money out before it matures without penalty. And that is a major difference from a CD. Whereas when you buy a CD and you want the money before it matures, the bank is going to penalize you about 3 to 4 months on average. And so whether or not you share the same feeling regarding the stock market as us, if as long as you have money that's sitting in the bank that's doing nothing, let's at least get it working for you in a better way than just your checking and the savings. Now let's take a look at some retirement and tax changes that are worth mentioning. So one, wanted to go over the new figures when it goes for the IRA and the Roth IRA. For 2024, the new contribution limit is $7,000 for everyone. If you are over the age of 50, you can do an additional $1,000. And so if you're over the age of 50, the total amount you can do is $8,000 for 2024. And another reminder that I should mention too is that if you have not yet contributed to your IRA or your Roth IRA for 2023, you still have time to do that. You still have time until April 15th, tax day. And so as long as you still want to do that, please call our office and let us know, and we can make that happen. The contribution limit for your 401k also went up for 2024. It is now 23,000. So for those over the age of 50, your catch-up contribution is 7,500. So if you're over the age of 50, the total amount you can do is 30,500. Now, a change that's going to go into effect next year impacts those that will be turning 60, 61, 62, or 63 only. You will get an additional limit that you can contribute to your 401k. So we just discussed the age 50 plus catch up. But if you happen to be one of these 4 years, you'll be able to do another amount in addition to that. That will come into the fold next year, and we'll keep you informed. The income tax brackets are going to revert to higher levels beginning in 2026. The current tax cuts are going to sunset, is the terminology they use in the tax world. And so we're going to get the higher tax rates again in 2026. So it's very important as we're thinking about planning, particularly for those that have inherited retirement accounts, on how we want to strategically plan distributions. Another item worth noting is that the estate tax exclusion is going to revert to lower levels beginning in 2026. We'll go into more detail with you personally. I don't want to spend, a ton of time on this topic at the moment, but wanted to make you aware. One item that we wanted to bring to folks' attention, and this is in the state of Colorado, is called the homestead exemption. And it's where you get 50% of the first $200,000 of actual value of your primary residence is exempt from property taxes. So here's how it works. You have to be 65 years old by January 1st, and you must own the property for 10 years, and you must actually live in that property for 10 consecutive years. So in order to qualify for this, you must apply by July 15th, and you must actually fill out a form. This is not going to automatically happen. You must fill out a form, and you must apply it to your county assessor's office. We provided a link here at the bottom of your screen. And when we send out the recording and the slides, you'll also be able to just copy paste that, and you can find the form as well as your county assessor's office to get that information to them. But this is very significant. I mean, this could result, depending on where you live, possibly a couple $1,000s. Now I'll turn it back over to Jordan to talk about some important reminders.
Thank you, Sam. As always, we encourage you to schedule a review consultation to come into the office, or if you'd prefer, we can do a Zoom call or just a old-fashioned phone call. We're never too busy to help, and again, would recommend that you do schedule that. A simple reminder that it's not too late to add to your IRA or Roth IRA and have it applied towards your 2023 tax year so that you do get that tax deduction. Something that we're going to be reaching out to those clients that do have inherited retirement accounts. There are rules that need to be followed in terms of distributions, and we want to make sure that we're ahead of the game as far as those inherited retirement accounts apply to you. And lastly, cybersecurity. Unfortunately, we're seeing this crop up time and time again. We've seen at least 4 of these issues this year alone. Please be extra careful when it comes to sharing financial information, especially online or over the phone. Reach out to our office personally, and any ways that we can help better protect your data and protect your security is of utmost importance to us. Okay, questions. This is the time we would ask you to type in your question at the bottom of your screen. There's a Q&A icon, and questions that you might have, we'd be happy to address those. And everybody has everything all buttoned up, it looks like. Oh, let's see if we have any questions coming in. Question just came in about the property tax exemption. So if you already have the property tax exemption in the past, do you need to reapply? Sam?
I am going to say that you most likely do not need to reapply, but let me do some more research and I'll get back to you on that.
Okay.
Actually, I just got pinged here that if you had been approved for the exemption in a prior year, you don't need to reapply again.
Okay. All right. Boy, we got lots of questions here. So the question is, if you're retired and make less than $6,000 a year, can you still contribute to your IRA? And the answer is yes. You are certainly able to do so, and it's not too late as far as doing so. Question, is now a good time to pay off your mortgage? That could be answered one of 2 ways, yes or no. I'm going to say it depends. And rather than giving a broad generalized answer, I would say that's something that you need to discuss with us, specifically related to your financial goals and particular needs. Any other questions that might be on your mind? Of course, you can call us and we can discuss this offline. We would love to meet with you in person or by way of phone or Zoom. Please call the office today, schedule your review. And we want to say on behalf of all of us here at Dechtman Wealth Management, we are grateful and appreciate the trust and confidence you have shown in us. Wishing you a wonderful day. Thank you.
Thank you.